Let's get your home loan rate down. We understand how important managing cash flow is for investors. That's why talking to one of our brokers can help you find the best loan options and a better rate. Your Finny loan expert will assess your loan and quickly spot a better option if it's out there. With access to over 70 lenders and a wide range of products, you're sure to get the lowest available rate in the market. Stop worrying about your repayments now and take charge of your financial freedom. Contact a Finny mortgage specialist today on 02 8866 2444 or visit our website at www.finny.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. I'm Grace Ormsby, and I recently had the opportunity to sit down with a big name in real estate, the agency managing director and group CEO, Geoff Lucas. We had a really great conversation around what happened in the real estate market of 2023 and what to expect from the real estate market of 2024, with a little bit of added insight into how the real estate industry itself is going to be playing the year ahead. So well worth a listen if you are a property enthusiast. I hope you enjoy. Hello, everyone. Welcome back to a brand new episode of REB Secret to the Top 100 Agents. I'm Grace Ormsby, and can you believe Christmas is just around the corner? It feels like the perfect time to be recapping the year that was, looking ahead to what 2024 could bring, and there's no better person to be talking to about this than the agency's managing director and group CEO, Geoff Lucas. Geoff, welcome to the show.
Thanks very much, Grace. Looking forward to having a quick chat about what we've seen and what we're expecting to see into the future.
After the comments that you made around what the RBA had done at the beginning of December, decision to hold those rates at 4.35%, I was like, we really need to unpack this a little bit more, because it's obviously been a pretty interesting economic climate over the past year that real estate agents have really been wrangling.
Yeah, the RBA, they're much maligned RBA. They get a hard time in the media sometimes, but, you know, there are external factors that we've got to take into account and international factors as well. And so whilst it's been very uncomfortable this year for many of those with mortgages, you know, it's somewhat of an economic necessity, the way that the RBA has treated that. And look, I, for one, think they've done a reasonable job. Perhaps they were too late on the uptake and too aggressive, but overall, I think that we're where we need to be with an outlook. I think, depending on the data that comes out around inflation and labour markets, I think that early 2024 we might just be in for perhaps one more 25 basis point increase. But that's looking forward, isn't it?
Yeah, I mean, but we can't help but do that, can we, at this point in time? You yourself had mentioned that we can actually expect a little bit more stability to come into the market over the next year. And it's probably a pretty welcome relief to hear that for a lot of people.
Yeah, look, I'm one that, I guess it might be to do with my age but and conservatism, but I'm one that thinks stability in the real estate or residential real estate market is a good thing. And I think looking back to the last 3 years or so, I think we've seen extreme volatility in residential prices, and there's probably almost a generation of people that kind of view it that way, and I don't think it should be. You know, housing is a necessity. I think that it should be seen as an asset class that is stable. It grows, of course, because Australia is such a wonderful and attractive destination, but it grows at a steady pace. So I think that's a little bit later for the future. This year was interesting. When we started off the 2023 year, there was an expectation from most commentators that we would see continued tightening in monetary policy and an increase in interest rates, and indeed we got that. But at the same time, the commentators were, almost all of them, expecting a reduction or a softening in residential prices. And we got quite the opposite. You know, right at the moment we're seeing CoreLogic telling us that we're around about 8% up nationally for the year. And so that was in direct contrast to what people expected. And there's many factors And I guess I've been quoted as saying that a little bit. There's this confluence of so many dynamics colliding at the same time, almost unprecedented. And some of those things have caused, obviously, this price increase. One of them, immigration. The government had I think when they did their budget, they had a target of something like 275,000, and we're looking at it's going to be something around 510,000. Hate to think what would happen if I ever got a forecast like that wrong. But those things, even though that impacts, first of all, the rental market, that flows into pressure into purchasing. And when there's limited supply of housing coming to the market, because things are changing so quickly and people are concerned, that creates an excess of demand over supply, hence price increase. The other thing, of course, is, we have had 425 basis points of tightening during this cycle, but it's important to recognise that hasn't fully worked its way through to the consumer's pocket. And there's a couple of reasons for that. One is the advent of the so-called mortgage cliff, which I don't think we've seen the full impact yet. We still have some 600,000 or so borrowers and households still to come off. And so that hasn't fully worked its way through. But there's another issue, and that was that $300 billion of pandemic relief that was pumped into the economy and pretty quickly found its way into consumers' pockets and therefore bank accounts. And what we've seen is that that's been parked largely in offset accounts. And Australia, more so than any other country around the world, has been very slow in working that down. We're one of the last to really work that surplus down. And so as a consequence of that, so many borrowers are now buffered from the interest rate increases when they do come off, because they've got these balances sitting in offset accounts. Now, over the next 6 to 9, 12 months, because of the cost of living increases, etc., that's going to be whittled down. And then you'll start to see an impact on borrowers and their cost of servicing. And I think that will be one of the major things that we start to see have an impact on the resi market next year.
It's going to be an interesting one, and obviously it's all crystal ball gazing. It's educated guesses, very educated guesses from your perspective, Geoff, just because you're entrenched within this every single day. I'm curious of your thoughts when it comes to the agents and the property managers who have been dealing with these situations, really. It's been an unprecedented 3 years, as you said. So many of them have had massive wins, massive years in the market. But how do you think that adjustment is going to go back from that volatility into stability? Is it going to be a bit of a tough pill to swallow for some people?
Call me old-fashioned again, but I think it will be a return to fundamentals. Mm-hmm. It won't be so easy. I think we went through a period of time, particularly with rapidly escalating prices, where, you just list something and off it goes. And so I think that's, as we go through this shift in momentum through to more of a buyer's market, it's going to get harder, and there's going to always be, when you go through that transition, there's vendor expectations that always exceed reality or the market. And so people will need to work much harder and more closely with their clients. I think there's still so many factors affecting the residential market that agents are going to need to make sure that they're availed of the best information, because consumers, mortgage holders, borrowers, households will be concerned, alarmed, confused and looking for guidance. So it's an opportunity to add value through their knowledge, and that's certainly what we try and do. I mean, my job is to make sure that I provide an environment for my people that equips them for success, and that includes disseminating the right information to them that they can then pass on to their clients. Look, that's from a sales perspective. From property management perspective, wow, that industry, people have worked so damned hard. COVID, that was probably one of the toughest industries to be in COVID. And now they're facing a situation where, landlords, and I guess kind of rightly so, are demanding increases in rent, and the market's allowing that because there's so much demand. And that's a difficult thing when they're speaking to their tenants about that. Again, a necessity to go back and really work closely with their landlords and tenants. We're going through a period also where we're seeing, Grace, a lot of investors looking at the risk-free rate and saying, oh, I can get 5.5%, maybe 6% risk-free, my mortgage on my investment property is now probably 7.25%, 7.5%, maybe more if it's in super, and saying it's now negative cash flow significantly. I'm better off selling that. I've received some capital gain and I'm going to put that money in something that's more stable and will give me a higher rate of return. So we're seeing churns of portfolios, rent rolls, and that creates a lot more activity for the property management people as well. So another year of hard work. In terms of volumes, we think that it's going to be a safer transactional environment. I said at the outset that more stability in prices is good for a long-term asset like housing. That also creates, I believe, more confidence in people being able to and willing to transact. In Australia, we have some 11 million residential properties and we turn over or sell just on 480,000 of those. And so when you do the mathematics on that, that means the average hold, the man or woman in the street thinks the average hold is somewhere around 8 to 10 years, but do the mathematics, it's actually 22 years. And so there's a lot of friction there. And I'm not sure about you, you're a lot younger than me, but I think my needs for housing change more regularly than every 22 years.
Yeah.
So we'd like to see more transactions. I think an environment of less price volatility will create that. More transactions, that's a good thing for our industry. It's also a great thing for Australian families because they're able to change houses more frequently to suit their family and changing needs.
Absolutely. And it sounds like there's a lot of opportunity there. We're going to come back just after a break to hear more from Geoff Lucas. Welcome back to this episode of Secrets of the Top 100 Agents. I am joined by Geoff Lucas, the agency's Managing Director and Group CEO. And Geoff, it's been enlightening chatting with you today. And I think a lot of people, I'm hoping they leave listening to this conversation a lot more informed about what could be happening in the year ahead. But one thing that you did bring up and how much volatility that we have been having, we're heading into stability. But the fact that that means more transactions is an interesting contradiction, I guess, in that the last 3 years have felt so chaotic for so many people. And I wonder if people were sort of hoping for a little bit of a break, a little bit of a cool down. Doesn't sound like that's going to be the case. So there's obviously just a mindset that's going to be required to be able to manage that and handle that in an appropriate way.
Yeah, and when I talk about more transactions, I mean, we've already started to see the natural lift that happens around spring, summer, etc. But there's something else at play as well. There is more supply starting to come to the market. We're not seeing a lot of distressed listings at this point, but all of the evidence points to the fact that households are increasingly stretched. And so we will see more volume of supply coming to the market. That will eventually work its way through to a lift in transaction numbers. And I'm not sure. I think most real estate agents will be quite welcoming of an increased number of transactions. But what happens on the way through, of course, is vendor expectations in a transitional market usually exceed reality. And so there's going to be some work to be done there. And that's where I guess the leadership, training, coaching, deal flow management comes in. There'll be a lot more of that required for the agents and the agent teams in terms of, educating the vendors, talking to them, giving them comparative examples, talking to them about what's happening in the marketplace, what's likely to happen in the future. So, a lot more work for people. So I hope they all enjoy their very short break. Yeah. Because it will be on again around about the 7th or the 8th of January. And I think the year will probably kick off a little earlier because of those things. I suppose the other thing to point out, Grace, is when we talk about more stability and, when CoreLogic come out with their numbers every week and every month, or whether it's PropTrack, we look at a headline number for national. And within that national number, we're thinking, or I'm expecting that next year nationally, we'll be looking in Australia at somewhere between -1% and +3% price change. But within that one number, there is so much variability. For example, at the moment, Perth, that has been the outperformer for the last 4, 5, 6 months. And I think they've had an annual price gain of something like 13.5%. Rents similarly up around 16%. And so you're seeing that compared to Melbourne, which is flatlining or maybe even dropping negative at the moment. So within that simple number, we talk about the market being up or down, but there are so many different markets within each state, within each city, operating all in different ways. So I suppose the message there is to do your research on specific local markets to understand what the drivers are there. Even within those markets geographically, price points are changing. And the most recent data suggests that the mid to lower price point is becoming very, very strong. That's a consequence of the banks re-rating borrowers and in some cases down in their purchasing power or borrowing power by 20 or up to 25%. That's forcing them to go down into a lower price category. And so those mid to lower price ranges are performing more strongly. Just one more point on prices, and when you talk about quartiles and the top end or the middle section, when the data comes out and talks about the top end, you might have recently seen that the mid to lower is outperforming the top end. Being based here in Sydney and a large part of our business in Sydney, the top end is a bit different to the top end of Australia. And that market at the $15 to $20 million and above is continuing to be robust, and we expect that to probably outperform the remainder of the market, certainly in the next 6 to 9 months, not affected in most cases by the cost of money and interest rates.
Yeah. I mean, I guess then it comes back to the fact it really pays for agents and business owners to really have an ear on the ground, be talking with some of the banks, brokers, financial people in their areas to actually find out what's going on. And that then can be the information that they pass on to their vendors to advise them.
Yeah, that's right. And in any transitional market where things are changing, it's information, it's value add that we as professionals can provide to our customers. And I think, that's what's going to attract people to brands or agents, knowing that those people or organisations that do provide value and information in what are often and probably will continue to be unprecedented times.
It would be amiss of me not to just bring up some of the things that are going to be coming into play over the next year, especially around, we're already seeing, the Help to Buy scheme getting a bit of traction, being talked about by governments as an option, that shared equity idea, the 5% loans, things like changing ways of how people actually access property. Do you think we're going to be seeing more people heading that way purely because that they need to get onto the property ladder?
Some of those schemes, they're interesting, aren't they? I guess I'm a little bit sceptical about the success of them because when you introduce a scheme that makes it easier, then often you just see the prices skip up by that particular margin. There's so much change going on in terms of one of the things that we're seeing is the rental market, because that's so tight, so tough, and in most cases around Australia, 10% plus. The migration of people that were previously renters that are saying, hey, irrespective of the cost of money, that is interest rates, because rents have gone up by so much, we're going to become first home buyers. Now, that's an interesting theme because at the same time, and I'm talking here the kind of the 211 apartment, that's a normal piece of, I'll call it stock, in a residential portfolio, investment portfolio. The investors are starting to see the cost of interest on those increase, so cash flows are going negative, and they're also seeing the attractiveness of a risk-free rate of, say, 5.5%, some cases 6%, saying, look, I've participated in a capital gain, I'm going to sell that. So what we're seeing there, and we expect to see more of, is investors selling, rent rolls reducing a little bit, but first home buyers being able to see more choice, more supply coming to the market, and then moving from renters into becoming first home buyers. So that's a nice thing that we're starting to see because it's previously been very, very tough and getting tougher. And in Australia, I'm not sure about you, but I think it would be a terrible thing if generations of people lost the hope to be able to be homeowners. It's one of the great things about our culture as a nation, I think, the aspiration to have your own place. And so that's a nice thing that we're starting to see. And maybe, just maybe, at the end of the year, subject to economic data, perhaps we might end 2024, perhaps, with a slight interest rate cut perhaps, and then eventually kind of coming off a little bit into 25. But that's a long way away.
Yeah. I mean, I was just going to go even further ahead and go, if the pendulum is swinging back that much just in 1 year, or could swing back that much in 1 year, what could potentially happen beyond that? I know it is very, very hard to tell, and the economic indicators will definitely give us more insights as we go along. But to be going into stability, do you think we'll stick in that stability, that stable area, or is that too much to ask?
No, I hope so. Again, my conservatism's coming out there. Look, Australia is such an attractive place on the world stage. We've seen, as I mentioned before, record immigration. That demand isn't going to change. I think I've been quoted probably 12 months ago talking about the possibility of just clipping or reducing the rate of immigration. I mean, it is a first-class problem that we have. And what we probably should be looking to do is just cut it back a little bit, but be far more selective. It's a unique resource that we have here in Australia, our way of life, our geography, and we can use this opportunity of such high demand to refine, for example, the skills. Wouldn't it be terrific to get skilled tradesmen and builders coming in now, a preference for that? Because at the moment, we've got an enormous problem in terms of trying to provide the government's target of 1.2 million homes in the next 5 years. We haven't got a hope in hell of doing that. The large infrastructure projects at the moment are taking away all of the labour, pumping up the building material prices, and the supply is not going to come for residential housing. Maybe if we can use that demand and immigration to attract those skills. You weren't around, but a bit like what we did in the 1970s.
I was going to say you're judging me a bit hard there, but no, 70s is probably
I thought I was safe.
a little bit. Yes, you are very safe there, a bit before my time.
But all quality problems, and we just need really strong, considered and thoughtful leadership. I won't go into politics, but that's what we need because we've got some incredible resources in this country. You know, we got the Olympics coming up in 2032 in Brisbane and for southeast Queensland. That's enormous, and it's going to showcase certainly Queensland and Australia to the world even further. So quality problems, they will become a problem if we don't treat them and manage them well. But wow, we've got an amazing period ahead of us.
Well, you brought up Brisbane. I'm going to have to bring up a few of the states just after the break. See you on the other side. There's more to come from Geoff Lucas. Welcome back to this episode of REB Secret to the Top 100 Agents. I am joined by Geoff Lucas, Managing Director and Group CEO of the agency. Geoff, just before the break, you brought up Brisbane and some pretty exciting things coming up over the next decade or so, and Australia-wide really huge prospects, especially if we are entering this more stable market for the next little while. I'm curious of your thoughts, given you talked about the volatility that does occur within those price forecasts over the next year and which areas might be more able to reap the rewards of rising markets over the next little while.
Well, I did mention Brisbane and indeed southeast Queensland. Gold Coast and Sunshine Coast are also going to be enormous beneficiaries of the increased, I guess, livability of Queensland, but also the increased awareness as we move in toward that kind of Olympic period, a little bit down the track, but the spotlight is going to be on southeast Queensland. So that augurs very well for Queensland. We've seen WA in particular be very, very strong. That will continue. Again, I talked about livability before. Cost of living over there is so much more affordable than here. We're seeing in our own business at the agency, we're fortunate to have a view around all markets across the country, and we're seeing a large migration of young people, professionals, being priced out of the market in Sydney, being priced out of the market on the Central Coast, and now looking to go further afar. And that's either southeast Queensland or across to WA. Interesting, prior to the pandemic, there was no consideration of WA. But I think the work from home thing has sort of taught people that they can work from different places, and WA is going to continue to benefit from that. So we expect that market to be particularly strong, certainly for the first 6 months. Another interesting one is our friends in Victoria. Now, they've done a lot of things to try and punish property owners or investors, but the fundamentals of that city will remain, and that's been flat and slightly down now. So longer term, mid-term to longer term, Melbourne will rebound. And so, particularly freestanding houses in this 10-kilometre radius of the CBD of Melbourne I would think that between the next 12 and 24 months would be an interesting one to watch. Look, supply and demand is something to look at as well. Brisbane, Adelaide and Perth have all got record shortages of listings.
It's crazy.
Yeah, and whenever you see that, there's going to be a pop, particularly with the increased, so reduced supply and increased demand. So they're going to continue to be pretty strong over the next 3 to 6 months.
You touched on work from home and that change that we saw very much happening through COVID. There's so much debate around whether that trend will continue, whether we're going to see people doing that. And obviously, I'm putting you on the spot a little bit here with that question, but is it something that is going to continue? We're going to see people continuing to demand that flexibility. And so will those trends continue of people moving to those areas or? Yeah,
I think, Grace, it will continue to shift back toward mainstream working from offices, but we're never going back to 5 days a week or 100%. I think it went obviously, we're enforced to go a long way work from home, but it's continuing to march back a little bit. We see organisations like ANZ saying, well, you won't participate in the bonus scheme unless you're working in the office. So I think we'll see more and more of that. I mean, we've shaped our business because we think the future of real estate, for example, is not in bricks and mortar offices. Transactions do not happen in bricks and mortar offices in real estate.
It's a good point to make.
Yeah, and so we build these large, functionally appropriate hubs, if you like, and sort of 3 or 4 in each major city where our agents can come and congregate and collaborate and then go out to their respective markets, which might be a radius of, 10 to 12 kilometres from that hub, and go and service those markets because the transactions are done, over your telephone or on a laptop or in a cafe or in a living room. But they come together because it's a people business and we're gregarious, and they come together to collaborate, but then go out to the markets to disseminate. So we're seeing a change. That shift toward work from home benefits us, and we think that'll be sustainable as well.
I'm glad you bring that up too, because I have noticed a real emphasis on decentralisation of those services that people do need. So this is kind of a reflection of that in itself.
Yeah, it is. Look, there's also an efficiency aspect to it as well. When you used to drive around again before your time, but you'd see a real estate office on every street corner, there's a massive duplication there. Well, first of all, it's not very sustainable because we're building these edifices and at great cost and expense for what? But then there's all of the labour of each one of those sites. So we figure it's a bit like the consolidation or aggregation of the Bunnings concept, where you used to have corner hardware stores and they'd all have their own cash registers, etc., and people and staff, and then along came Bunnings. And they've done it really well. You're smiling. It's a great experience there, isn't it?
That's beautiful.
And so I guess we see our model as providing that and making it more efficient, and that benefits not only our people, but we think that it's an efficiency of information that's then provided to our clients as well.
Keeping the attention then on the agency, obviously you're an expert, you work there. What has the last year been like for you? Because it has been an interesting one based off what we've talked about today, just such a different marketplace to traditional real estate.
Look, I think unashamedly, I say a lot, I've got the best job in the country, seriously. We're in most of the major markets around Australia, so we see them all moving differently. We're in a growth phase. We're only 7 years old as a business. We do have a different model, as I started to outline there. And so we're seeing enormous growth opportunities for our business in all of the markets. Over in WA, we're number 2. We have about 6.5% market share over there. On the eastern seaboard, we've got some growing to do. We've got about 420 agents at the moment, about 10,000 properties under management. So we're seeing enormous growth opportunities. So we're looking at those, but it's not just for growth's sake. We're going into communities that we think our style of business can add some value. And so I guess the outlook for us is to grow by organic growth, which is agents saying, hey, I really like the agency model. I'd like to come and work with you. But we're also a listed company, and so we can use our balance sheet and resources to go and acquire businesses. And we've also, interestingly, in the last 12 months, launched a fund that is a fund that's available for high net worth or super funds to invest in that can then go and buy businesses and we manage them for them. So that will help supercharge our growth as well. So a lot on for us in the next 12 to 24 months, Grace.
Yeah, that fund is an interesting path to go down. But I spend a fair bit of time with people that work in the financial spaces as well. And even just the fact that super is getting so big, they've even got, things like Aware Super heading over to London, looking into the real estate sector.
Well, it does. It provides investors access to the residential property market because essentially what they're buying is a fund that invests in rent rolls. And so that's a nice thing for us as a listed company because it's a capital light expansion. So the fund acquires the assets that we say, yes, that's a good business. The sales part of the business comes across to us and we superintend the management because we're experts of that rent roll. So it's a nice way for principals that are out there in the marketplace that are saying, hey, look, I've built this business, but I really wanted to get into the business because I love listing and selling. But all of a sudden they've built this business that's got all of these administrative burdens. They can sell that to us via the fund and come across and go back to listing and selling. So we see that as a really exciting development. We've deployed so far about $30 million. The most recent was the Divine acquisition. And we're getting a lot of inbound inquiry now for people that want to do that. So that's going to further fuel our growth, certainly on the eastern seaboard.
I do love with the agency, you've got that really big presence across West. You don't see many businesses that start out that way and then manage to tap into the East Coast markets. They're either not interested or they really, really struggle to do that.
Yeah, look, it's not easy. Pre-pandemic, it was almost, if I can say this respectfully, a different country.
Yeah.
And it's not easy for most people. We're lucky because I guess the business was originally born over there and we learned things because that market moves and operates differently to the eastern seaboard. That gives us some risk mitigation, but also they do some things, God bless them, that are a little bit different. And we can learn from that. And we love doing that. So we adopt practices that we trial and implement over here in the East. Other businesses in our sector don't get the opportunity to do that. So we really love being across different markets and in different markets because we want to continually improve. But it's also a beautiful place over there to visit, isn't it?
Oh, it is. We've had conversations before. We've both spent some time there and it is a beautiful part of the world. As you mentioned, you're not paying an arm and a leg for parking either.
Yeah, well, you can go to the beach and have a swim, and you don't have to pay $24 for your hours parking. But no, it's a lovely place. Livability is, I think, the top city in Australia in terms of livability, and a lot of growth to happen there as well. And the economy there is extraordinarily strong, courtesy of the mining sector. And that's going to underpin them for some time. Also the home of many great entrepreneurs, which is the reason I was saying we can learn so much from them.
Yeah, so then this East Coast expansion and what's next for you guys, obviously you probably can't tell me everything, but are there some exciting developments that just come by virtue of that over the next little while?
Yeah, we've, on the East Coast, we've obviously got from down south in Tasmania, we've just put on a new general manager in that business. That's growing really strongly. We're in Launceston there and we're looking to go further, Devonport and also Hobart, to get a bigger presence down there. Then on to Melbourne. Melbourne, Victoria is an enormous market. We're relatively young there and we've got a very, very small market share. So we've actually got a couple of exciting developments that are happening that I can't talk about, but that you'll probably see in the industry trade about some people that are starting to join us in that market down there. So looking to do some good things in Victoria and also Queensland. We're only, I think, 2.5 years old in Queensland. We're growing nicely down on the Sunshine Coast around Buderim. We're looking to further our presence there on the Sunshine Coast. Gold Coast, there's also something probably in January that we'll be able to talk to you about as well. Mm-hmm. Perhaps that's down the southern end of the Gold Coast, which is, as you probably know, a beautiful part of the geography up there. So we're doing some interesting things there. And also obviously in Brisbane, also looking regionally as well. We're relatively strong in Toowoomba and also up in Rockhampton. So look, it's going to be busy.
Yeah, sounds like it. And obviously in a more stable market though, it's got to be an exciting time to be having the best job in the world. Yeah,
well, Australia, I said, perhaps it's the world. But look, it's just the important thing to remember with that comment around stability is within that stability in Australia, we think -1% to 3% price movement. But within that, different markets will move differently. And you might get a 5 to 7% or maybe even 10 to 15% in different specific markets. But yeah, I'm looking forward to the volatility and confusion being removed so we can get back to the fundamentals of providing value to our customers and giving them long-term comfort.
Geoff, it's been an absolute pleasure to chat with you again. I think we'll need to put this in the diary again for 2024 and see how many of these expectations do come to fruition. But thank you so much for taking the time.
You're most welcome. Yeah, we look forward to doing that again. Thanks, Grace.
And that is a wrap on my conversation with Geoff Lucas. I hope you enjoyed it and found it quite enlightening and informative as I did. Any questions, editor@smartpropertyinvestment.com.au. And if you like this episode, like or review us on whatever platform that you do listen to your podcasts on. Check us out on social media and stay up to date with all the latest updates on our website, www.smartpropertyinvestment.com.au. Make sure you keep an eye out on the Fast 50 report that will be coming soon. But in the meantime, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.